We are always being asked, how can I reduce my tax bill legally? Well, in this video, I'm going to give you 5 simple ways to reduce your corporation tax bill in 2022. If you haven't subscribed yet, hit the subscribe button and turn on the bell so you know next time I upload a video about all things business money. I am Annette Ferguson, Chartered Accountant and Certified Profit First Professional, and I run Annette Co, a UK-based accounting firm. The overarching rule when it comes to your limited company's tax bill is that you pay tax on the taxable profits of the business. And the taxable profits are made up of the income, the sales, minus the allowable expenditure of the business. The expenditure that you have in your profit and loss account for accounting purposes can and often is slightly different to the expenses that are allowed for tax purposes. For example, let's take client entertaining. Now, if you are paying for client entertaining, that will appear in the accounts of your business. It will appear in the profit and loss account. But when it comes to calculating tax, it's actually disallowed for tax purposes. And yes, I know that seems completely unfair and not how business actually works in reality, but nevertheless, those are the rules under the tax legislation. So sometimes they don't really make much logical sense either. And what that means is that there are often things that can be overlooked that can be claimed by your business in its tax return. So I'm going to cover off some of those that are often forgotten about in today's video. Let's start with plant and machinery. From the 1st of April 2021 to the 31st of March 2023, plant and machinery purchases qualify for 130% allowance in your tax return. What that means is that when you buy a piece of qualifying plant and machinery, you can make use of a piece of legislation called super deduction, which means that instead of using the capital allowance and annual investment allowance legislation in calculating your corporation tax return, you should be using the super deduction legislation and ensuring that you claim 130% of the cost of your purchase. The second is director's salary. Now, it might be that if you've put a lot of money into your business when you first started it up, that you're taking money out via your director's loan account because there are no tax consequences. However, what you do need to do to make your business and yourself the most tax efficient as possible is to pay the directors yourself up to the personal allowance level. This is typically for the current tax year £12,570, although you do need to check your PAYE coding notice, which will be issued by HMRC to ensure that is the correct level for you. But if you are paying yourself up to that level, that salary portion is tax deductible against corporation tax. So the salary that you pay to yourself via payroll is an allowed deduction for corporation tax and therefore reduces your corporation tax bill. Now, if you're making sure that you pay yourself tax efficiently as an individual as well, then you've got a win-win there. I will also link in the description to this video, my video on paying yourself in a tax efficient manner as a director of a limited company from a personal tax perspective as well. And the third is pension contributions. You can make contributions from your company into your own pension scheme, into a registered pension scheme that you have, and that is tax deductible. So you are allowed to make those pension contributions, and that reduces the amount of corporation tax you pay, which essentially means as a director, you increase your overall package that you are paying to yourself. And yes, you're not taking the money today, but you are squirreling that away for the future into your pension. So don't make those pension contributions out of your after-tax salary or out of your dividends that you have received. Make it from the company itself directly and you'll be able to claim that corporation tax relief. And if you're getting value from this video, do make sure that you hit that like button. Business mileage. This is something that often people forget to include. If you are using your personal car for business purposes, then you can claim the mileage that you are traveling for the purposes of business. You get that mileage payment on a tax-free basis, and the company gets it as a deduction for corporation tax. So again, it's a win-win situation. If you're driving up to 10,000 miles in a year for business, you can claim 45 pence a mile, and anything above 10,000 miles, it's 25 pence. There are also incidentally rates for using your bicycle for mileage for business as well. So it doesn't just have to be travel in a car. You need to keep note of the mileage you are doing for business purposes, but that can be just jotted down in a notebook or in a spreadsheet. And if you do this on a monthly basis, it makes it a lot easier than waiting until the year end and trying to work out where you've been and when. Work from home allowance is allowed when you are working from home. That means that you get an allowance through the tax return of the business as a deduction for corporation tax for working from home. So make sure that that is included in your tax return, particularly if you're someone who doesn't typically usually work from home, but over the COVID period have been forced to do that. As a starting point, a £4 a week payment from the employer, i.e. the business, to yourself is completely acceptable. That payment is tax deductible in terms of corporation tax for the business. And a big note on this, remember and file your corporation tax return and make your payment on time. Because if not, you have fines and interest to pay, and those are not tax deductible. So your corporation tax deadline is 12 months after the end of the accounting period for the submission of the return. However, the payment deadline is 9 months and 1 day after the end of the accounting period, which really in reality means that you have to have the return prepared by then as well, because if you don't have the return prepared by then how would you know how much to pay? So it's always best to work on that 9 month after the end of the accounting period date in your head, because that is when the return will have to have at least been prepared and you have your payment due 9 months and 1 day after the end of the accounting period. If you submit your return on time and your payment on time, you will have no interest and no penalties to pay. Now, if you are struggling with all things accounting for your business, I would love to help. Do reach out to me at yt@annetteco.uk and let me know how I can support you. Thank you so much for watching. Hit the like button, subscribe, and I'll see you in the next video.